The global economy is facing significant headwinds. Markets are volatile, and investors are increasingly worried about the future. Uncertainty reigns as multiple challenges converge to create a perfect storm of economic instability. The financial landscape is more unpredictable than ever. From rising inflation to escalating geopolitical tensions, the current market turmoil has left many wondering about the future. Investors are on edge, trying to navigate these turbulent times. One of the most pressing issues is the ongoing war in Ukraine, which has far-reaching consequences. The conflict has disrupted global supply chains, leading to higher prices for energy and other essential commodities. This disruption is felt across various sectors. This has fueled inflation worldwide, forcing central banks to raise interest rates in an attempt to control the spiraling costs. These rate hikes, while intended to curb inflation, also risk slowing economic growth. The balance between controlling inflation and maintaining growth is delicate. Adding to the uncertainty is China's economic slowdown, which has significant implications for global trade. As the world's second-largest economy, China's performance has a ripple effect on global markets. Its economic health is crucial for global stability. Its strict zero-COVID policy and a property market crisis have hampered growth, impacting demand for goods and services worldwide. The global economy watches closely, hoping for signs of recovery. The interconnectedness of the global financial system is more evident than ever in times of crisis. The intricate web of financial relationships and dependencies means that no country operates in isolation. Events in one corner of the world can quickly reverberate across borders, impacting markets and economies far and wide. A single event can set off a chain reaction, affecting financial stability globally. This interconnectedness stems from the complex web of trade relationships, financial flows, and investor sentiment that bind nations together. These ties are strengthened by international agreements and global trade policies. When one country experiences economic turmoil, it can trigger a domino effect. The ripple effects can be felt in various sectors, from manufacturing to services. For example, a stock market crash in one region can lead to a loss of confidence among investors globally, causing them to pull back from riskier assets. This loss of confidence can spread like wildfire. This can result in a cascade of selling pressure, pushing markets down further. The panic selling can exacerbate the situation, leading to even greater financial instability. Moreover, the globalized nature of supply chains means that disruptions in one part of the world can quickly impact businesses and consumers elsewhere. The interconnected supply chains are vulnerable to even minor disruptions. The COVID-19 pandemic provided a stark reminder of this interconnectedness, as lockdowns and factory closures in one country led to shortages and delays across the globe. The pandemic highlighted the fragility of our global systems. Japan, the world's third-largest economy, has been grappling with economic stagnation for decades. Despite massive government spending and ultra-low interest rates, the country has struggled to break free from deflationary pressures and sluggish growth. This prolonged period of economic malaise has led to a unique situation in global finance. The Japanese yen has become a funding currency for the carry trade. The carry trade is a strategy in which investors borrow money in a low-interest rate currency, such as the yen, and invest it in higher-yielding assets denominated in other currencies. This strategy profits from the interest rate differential between the two currencies. Japan's near-zero interest rates have made the yen a popular funding currency for carry trades around the world. The U.S. Federal Reserve's recent interest rate hikes have sent shockwaves through the global financial system. As the world's largest economy and the issuer of the global reserve currency, the United States holds significant sway over global financial conditions. When the Fed raises interest rates, it makes U.S. dollar-denominated assets more attractive to foreign investors seeking higher returns. This increased demand for U.S. dollars can lead to a strengthening of the dollar against other currencies. For countries like Japan, where the currency is used as a funding currency for carry trades, a stronger dollar can have significant implications. As the dollar appreciates, the cost of repaying yen-denominated loans increases for carry traders, squeezing their profits and potentially forcing them to unwind their positions. Section 5. Currency fluctuations and market jitters. Currency fluctuations can have a profound impact on financial markets and the global economy. These fluctuations are often driven by a variety of factors, including geopolitical events, economic data releases, and changes in market sentiment. When exchange rates move rapidly, it creates uncertainty for businesses and investors, making it difficult to plan and make informed decisions. This unpredictability can affect everything from pricing strategies to investment portfolios. This uncertainty can lead to market volatility and sell-offs as investors become risk-averse and seek safe haven assets. The resulting market jitters can have a ripple effect, impacting various sectors and economies. One way in which currency fluctuations impact markets is through their effect on corporate earnings. Companies must navigate these changes to maintain profitability. Companies that operate internationally often generate revenue and incur expenses in different currencies. This exposure to multiple currencies can complicate financial planning and forecasting. When exchange rates move against them, it can erode their profits and make them less attractive to investors. This can lead to a decline in stock prices and overall market confidence. Moreover, currency fluctuations can influence central bank policy and interest rates. Central banks closely monitor exchange rate movements to make informed policy decisions. A sharp depreciation in a country's currency can lead to inflationary pressures, as imported goods become more expensive. This can affect consumer spending and overall economic stability. This may force the central bank to raise interest rates to combat inflation, potentially slowing economic growth. The interplay between currency values and economic policies is complex and far-reaching. Section 6. Japan's Balancing Act, Navigating Interest Rate Policy. Japan's central bank, the Bank of Japan, faces a delicate balancing act in the current economic climate. On the one hand, the BOJ wants to support economic growth and combat deflation, which has plagued the country for decades. On the other hand, maintaining ultra-low interest rates, while other major central banks are tightening monetary policy risks, further weakening the yen and potentially fueling inflation. The BOJ has so far resisted pressure to raise interest rates, arguing that the current rise in inflation is transitory and driven by external factors, such as higher energy prices. However, the widening interest rate differential between Japan and other developed economies has put downward pressure on the yen, making imports more expensive and squeezing household budgets. Section 7. Unemployment, a looming recession indicator. The unemployment rate is a closely watched economic indicator that can provide insights into the health of the labor market and the overall economy. A rising unemployment rate can be a sign of a weakening economy, as businesses lay off workers in response to declining demand or economic uncertainty. In the United States, the unemployment rate has remained relatively low in recent months. However, there are signs that the labor market may be cooling. Job growth has slowed, and some companies have announced layoffs, particularly in the technology sector. A significant increase in unemployment could be a sign that the U.S. economy is heading toward a recession. Section 8. Oil prices, a barometer of consumer confidence. Oil prices are another important economic indicator, reflecting global demand for energy and consumer sentiment. When oil prices are high, it suggests strong economic activity and consumer confidence. Conversely, falling oil prices can indicate weakening demand and economic uncertainty. Oil prices have been volatile in recent months, influenced by factors such as the war in Ukraine, OPEC plus production cuts, and concerns about a global economic slowdown. High oil prices contribute to inflation, eroding consumer purchasing power, and potentially slowing economic growth. Section 9. Weathering the storm strategies for investors. Navigating economic uncertainty requires a disciplined and strategic approach to investing. Here are some strategies that investors can consider. Diversify your portfolio. Don't put all your eggs in one basket. Diversifying across different asset classes, sectors, and geographies can help mitigate risk. Focus on quality. Invest in companies with strong balance sheets, solid earnings growth, and a history of weathering economic downturns. Consider value stocks. Value stocks, which are undervalued by the market, may offer attractive investment opportunities in times of uncertainty. Don't panic sell. Avoid making impulsive investment decisions based on short-term market fluctuations. Stay focused on your long-term investment goals. Seek professional advice. consult with a financial advisor to develop a personalized investment plan that aligns with your risk tolerance and financial objectives. Section 10. Finding opportunity in uncertainty. While economic uncertainty can be unsettling, it's important to remember that markets are cyclical. Periods of volatility and downturn are often followed by periods of recovery and growth. Investors who can maintain a long-term perspective and stay disciplined in their approach can find opportunities to capitalize on market fluctuations. History has shown that markets have a remarkable ability to rebound from adversity. While the current economic landscape may seem daunting, it's essential to remember that uncertainty is a constant in financial markets. By staying informed, managing risk, and focusing on the long term, investors can position themselves to weather the storm and emerge stronger on the other side.